Good morning and welcome everyone to the Moneycontrol live stream. You're watching the opening bell and I'm your host Nikki Mirchandani. Well, markets look set for a cautious start. Wall Street closed lower, rattled by Yellen's comment and less by Fed's rate hike. US Treasury Secretary Yellen says not considering blanket insurance for all US bank deposits. Fed hikes rate by 25 basis points, marking 9th consecutive rate hike, which is the highest level that we've seen since September 2007. It's indicated a softening stand, but has projected deeper cuts for economy growth. In terms of the Asian markets, they're not doing too well, fallen on Thursday following Wall Street's reaction overnight. SGX Nifty indicates a flattish to a start coming in with negative bias. Talk about the FIIs, that's where the surprise is. It's turned buyers for the first time in the last 10 straight sessions. FIIs have bought in shares to an extent of around 61 odd crore on March 2022. Beg your pardon. And DIIs, they've bought in shares to an extent of around 383 odd crore. In terms of the stocks that we're tracking this morning, of course, something in the rate sensitive, something like an IT, they're going to be continuing to be in focus. And Hindustan Aeronautics, keep an eye out on that one. The government is going to be selling in 3.5% stake in this one via OFS. Hero MotoCorp, where another auto players is coming up with the revision coming in on the price hikes, both for motorcycle as well as scooter segment from April 1. Now, NSE and BSE both will be putting in Adani Power under ASM framework yet again. But it's an important day, eventful day. We have a lot lined up today. But before that, let us just get going and discuss some stocks and strategies with Chandan Taparia, who's the head technical and derivative research at Motilal Oswal. Good morning, Chandan. What are you making out of the markets right now? Weekly expiry combined with the Fed rate high, Yellen comments. What is the strategy and the levels you think that investors or traders should approach at this point of time?
Good morning. Thanks, Nikki, for having me. So I think now this one more Fed rate hike is over. That event is over and volatility is likely to cool down. They increased the rate by 25 bips to 5%. So because of that, US market reacted. But I don't think that Indian market will react much. Even as per the early indications, we are not opening much down. So for me, the important level will be 17,071. So after the gap down opening, if Nifty manages to hold 17,071, I think it will find stability with support of 16,950 to again potential to bounce towards 17,250 to 350 level. So I'll utilize this decline for buying approach. Now the question is, what is the reason that even after the decline in the global market, we are slightly looking for buy on dip strengths? First thing is that volatility is likely to cool down.
And then, Chandan, just 30 seconds to the market open. Buy on dips is the strategy that we are looking at immediate, resistance and support levels before we kind of address the market opening.
17,950 and 17,250, 350 are the levels to play in the market.
All right, that's the word coming in for the Nifty buy on dips, and that's the levels that Chandan has suggested. It's a weekly expiry day, so expect some volatility to play out for the session overall. But we're going to be on the sidelines waiting for the markets to open just to see if we are looking at a negative start coming in for Indian equity markets, just in line with the globe. But there we are. It's somewhat to an extent we are looking at a positive start coming in for the markets. A matured reaction, if I may so say, 0.4% on that one. So gains looking out for Nifty as well as Sensex. A positive start, unlike what the globe has been doing. Do bear in mind it's a day when option call writers would be actually active. It's a weekly FNO expiry day, along with the host of events that have played out for the globe, of course. Let's also look at Bank Nifty, whether there's a support coming in for Bank Nifty levels. If you can pull in Bank Nifty levels out just to see how the market has been stacking up. In terms of Bank Nifty, we also, that's some amount of traction building in even for the Bank Nifty levels right now. If you look at how the sentiment is faring overall, That's something that needs to be seen. In terms of Bank Nifty, it's actually, sorry, beg your pardon, it's the losses that had come in for the markets. We are looking a start which is in sync with the globe, 0.5% on that one. So do keep an eye out on the banking index. Also, mid-cap index, that's where we are looking at negative traction building in, even on the broader index. Something like a mid-cap, small cap, they've not been holding up, down and out with losses to an extent of 0.2% for that matter. If you can quickly also look at Bank Nifty again, just to see the flavor of the markets before we give in the sectoral indices. Of course, Bank Nifty has been trading down and out, but how Nifty has been faring, it actually losses, beg your pardon, coming in for the Bank Nifty 50 index. The opening is not different. It's just in sync with what the globe has been doing. 15 minutes early, 15-20 minutes, that's where most of the reaction will come in. Remains to be seen if we can reverse that, given that it's a weekly FNO expiry. Has not held on to that 17,100 mark, trading down and out with losses of around 0.4% in terms of advance declines to an extent of 37, advances 13. Look at the sectoral indices performance out there. That's clearly where we are looking at. Nifty Metal Index also is something that we are looking at this point of time. It is a negative start coming in for the markets. Market breadth at this point of time is also negative. So net remains to be seen how even sectoral indices are doing per se. In terms of the Nifty IT index, in terms of the Nifty Realty index, that's something where we need to assess. Nifty IT, losses of around 0.5%. Media is down. Banking, of course, like we mentioned. Auto with slender losses of 0.1%. Private bank, PSU bank. Only amount of traction, rather, is coming from Nifty Pharma index. That's the one which is holding up in green. But we are also assessing the impact overall of how this has moved. We'll decode the impact of Fed rate hike, Yellen comments for Indian equities with Santosh Nair, who is the editor, CNBC-TV18.com, before we go back to Chandan and ask him about the levels. Good morning there.
Hi, good morning, Nikki.
How are you reading into it? Of course, there's a negative start coming in for the markets, which is pretty much in sync with how the globe has been doing. You think Yellen comments are more scary as compared to the Fed rate hike and the projections of downward economic growth?
Well, I'll take the Yellen comments first. Now, I think the market misinterpreted what Janet Yellen had to say yesterday, but she had clearly said that similar action could be warranted at smaller institutions if there is a deposit run and there is a risk of contagion. So there are two conditions there. One, there should be a deposit run, and two, there should be a risk of contagion. Now, nowhere did she say that there will be a blanket protection to all deposit holders, which is how many observers actually interpreted it. So that was the confusion, and she has just clarified on that, saying that it doesn't mean that there's a blanket protection to all deposit holders. Now, this is partly good for the banking system, because a blanket protection, what it actually does is that it breaks the discipline and it encourages more risk taking by the bank management, and at the same time it also makes depositors a little careless, because right now if you know that only $250,000 of your deposits are insured, you will be a little more careful about spreading those deposits, spreading the risks. But if there is no such fear, then what would happen is that depositors may tend to concentrate all their money in one bank, and from the bank's perspective, if they know that depositors anyway won't leave them, they might pursue aggressive or reckless strategies. So all in all, this is not a very good idea, Nikki.
So markets have misinterpreted. So you think this is something which is actually positive coming in for the US banking system? Of course, like we discussed, it's going to be a near-term painful act which is going to happen, and probably the banking system will be more insulated for the long term given the kind of measures that they're seeing right now. And with respect to that, do you think also Indian IT sector would see some near-term pain before it kind of, again holds up to the valuation and the fundamentals as well?
Well, the bigger worry right now is mainly the Fed's action. Now, it has raised deposit rates by 25 basis points, but at the same time, Nikki, what it has said is that there could be some amount of credit tightening in the system, in the economy, because of the problems that you are seeing in the banking system. Now, what was the Fed actually trying to do? it was trying to reduce the flow of credit in the system, which is what it was trying to do when it was raising interest rates. Now, what it has said is that, now I won't do all the bad work. Anyway, we've got the problems in the banking system, so that itself will contribute to the tightening of credit, which means that growth then could be affected. I think that is what is spooking the markets. And already, if you see the impact of the previous rate hikes, they're slowly being felt. If you look at the leading US tech companies, they have laid off about close to 52,000 people already, and this is the headline numbers. In addition, there would also be layoffs in some of the smaller organizations which right now are not making headlines. Now, labor has been one of the tricky problems for Fed. That is something that it's not been really been able to address, though it has been raising interest rates for quite some time now. But those, the cumulative effects of all those rate hikes, it seems like is now slowly being felt.
But isn't the labor market the strongest that we've seen in 50 years? And also, when you talk about the rate hike, it's almost now indicated that there will be some softening of stance coming in the next probable meeting, because the targets have been more or less kept the same for 2023. You draw some solace out of this?
Well, yes. Now, what Fed Chair Jerome Powell has actually said is that there's only one more rate hike coming, but at the same time he has said that there won't be any cuts coming. Definitely there could be a pause, but that is also again consistent with his previous stance that interest rates could stay higher for longer. So that is something probably the market is still not reconciled to. What it is interpreting is that one more rate hike, and then probably after that you will see rate cuts coming. But again, Mr. Powell has clearly said that there is already some bit of credit tightening in the system because of the problems in the banking system. So already you could see growth getting impacted and also interest rates staying high. So this is a bit of a lethal combination from two perspectives. One is that it affects the profit margins of companies because of higher interest rates. Secondly, if interest rates are higher, there is always a tendency for investors to take some money out of equities and then park it in fixed income instruments. So this news is not very good for equity markets, at least over the longer term.
Actually, I was leading into it a little differently. I mean, there's a difference of opinion coming in. I mean, a little bit on that one, because something which is happening in sync with what the expectations were. Do you think more damage would have done if probably Fed would have kind of taken a pause, acknowledge what was going along, and probably that would indicate that there are more risks coming into for the system? Right now, it's just sticking to the stance, saying that probably the banks aren't as much in a problem that as much as is anticipated. Don't you think that aspect would have been a little of solace coming in for the markets? I mean, how different are we on this point of time?
Well, see, you got conflicting signals coming there. The mood is clearly jittery. Nobody wants to guess what the extent of the problems could be. A lot of these problems has been created largely because of rising interest rates. There's no cure for that really. It's not that these banks went and made loans to the wrong set of people or invested in the wrong set of securities. Much of the problems are being caused because of rising interest rates. And the second part is that you are going to see credit flow getting tighter. So Fed not raising rates doesn't really mean that the economy's problems have now been fully resolved. What he's saying is that probably even I don't know where the next set of problems are going to come from, and there is already some bit of tightening happening in the system. So let that now do the rest of the heavy lifting and cooling down the inflation.
That's a fair point taken. I mean, there have been statements acknowledging that this has happened. And Santosh, also we've seen FIIs now turning out to be the buyers for the first time in the last 10 days of they being the sellers.
Less than 100 crores, Nikki, though.
That's a very minuscule amount. That was precisely that I was coming to. It's less than 100 crore. It's a slender amount. Do you think it's just a breather of sorts? And again, we are going to look at the same amount of sell-off that has been thus far played in the last couple of years, and this year is no different. How do you look at the situation?
Again, hard to guess what foreign funds will be doing, but what I gather speaking to people in the market is that right now there is still some bit of discomfort with valuations. Foreign institutional investors think there are better markets where they're getting stocks at far more reasonable price within Asia itself. So you're seeing money flow to other markets. That's one part of it. Secondly, the outlook on earnings growth is also not as bullish as it was till, let's say, 1 quarter back. So that while you have a fair bit of price correction over the last couple of months, let's also not forget that the outlook on earnings growth has also is also reduced compared to what it was a couple of months back. So in fact, lower prices are just reflecting a more subdued outlook on earnings growth. That is something we'll need to keep in mind.
Santosh, that's fairly a good assessment coming in on that one. I hope we've been able to decode the entire impact with you. Santosh, thank you so much for taking out the time this morning and having a conversation with us. We're just going to resume back the conversation on the markets and the levels and the impact thus far that we have. If you talk about the Nifty 50 top gainers, top losers, Hero MotoCorp, that's where we're seeing top gainers, L&T, Bharti Airtel, Sun Pharma, Nestle India. These are the top gainers that we have on our list. If you talk about the top losers, we have something in the likes of Asian Paints, Wipro, Power Grid, HDFC. These are the top losers. But I'm going to quickly toss it back to Chandan and ask him what are the levels that we are looking at, as compared to now that the market has opened negatively. How are you assessing the markets, and what are the pockets that you would now want to trade in?
Right, so I'm closely looking at two levels in next 10-15 minutes to get any set of trade in the market. 39,750 in Nifty. If that level is being held, then I think I can play the bounce of 150-200 points. Similarly, 17,071. We are slightly near to the same. So if that level is surpassed, then only I'll play for some bounce back. So we are near to an important level in the market, and let them hold, then only we can play the bounce setup in the market. So I think just wait for 10-15 minutes and these levels will decide the market setup over the day.
All right. Any pocket of, how are you looking at IT stocks right now? How's the IT basket holding up for you? And also your strategy right now on Bank Nifty, please.
Yes, so first, if I talk about the Nifty IT that is continuously falling down, the weak structure is clearly visible. And even Nifty IT has broken the major support near to 28,000, trading below the same. From last 24 trading session, this index is continuously making lower top, lower bottom. So weakness could continue. We'll avoid going for bottom fishing in IT. In fact, the weakness could continue, and counter like Mphasis and Coforge are likely to be under pressure in the market. Now, if I talk about the Bank Nifty index that comparatively may hold, we have 39,400 is a major support. And if it holds 39,750 now, then we can play for a bounce towards 40,000, 40,250 in the banking index.
All right, Chandan, we'll just kind of leave it at that. Thank you so much for taking out the time and speaking to us as always.
Thank you.
All right, we've already decoded the impact of what Yellen has to say and how the Fed rate hike has stacked up with the editor that we had internally. But joining us today is Amit Cheswani, the CFA, CMT founder and CIO of Stallion Assets. It's going to be decoding and probably letting us know the pockets now which look attractive to Amit. Good morning, Amit.
Morning, Nikki. Thank you so much for getting me on this show.
Pleasure is all ours. Okay, I'm just going to, just a deep dive into what the conversation is about. How are you reading into Fed's rate hike stance, underlying tone, combined with Yellen comments for Indian equity markets?
There are only three things that matters. The Fed, this week's printing data will be very important. The Fed's balance sheet size at peak in March 2022, 1 year before today, was $8.9 trillion. And the Fed said that they will cut the balance sheet size till the 6th of March. That is 2 weeks before today. The balance sheet size came down from $8.9 trillion to $8.3 trillion. That means the balance sheet size went down $600 billion. And last 1 week, the Fed printed $300 billion. Now, this printing data is one data that I'm going to look out for. If this data crosses $9 trillion again, you just go up there and keep increasing your beta. That is number one. Number two, the Fed, the US 0 to, of course, everyone knows the Fed has hiked by 25 bips. It was a tough situation. That is facts, but and we're not in the business of predicting so much, but reacting to information. The 2-year bond yield of the US Treasury 2-year bond yield is now below 4%. It is very clear that the markets are expecting a pivot. It's showing. See, the market doesn't follow the Fed. And the actual thing is the Fed follows the market. The markets were the first ones to say that the Fed will hike. The 1-year bond yield, the 2-year bond yield were rallying way before the Fed actually increased rates. Even on the downside, in October 2022, the 10-year bond yield peaked. Last month in March, this month in March, the 2-year bond yield has peaked. Basically, and Bitcoins has moved higher. Basically, the inflation has peaked long term at 9.1%. 2% is Fed's goal. We are at 6%. The trend is lower. I'll be surprised if the market sells off a lot because of the Fed news. Of course, 1-2 banks going bankrupt. More in the US market can't be ruled out. Probably more also possible, but that increases, like these banks actually have no large economic impact because at the end of the day, the Fed will have to bail them out. Everyone knows how this is going to end. That the Fed will have to bail them out. There's no way you can let your depositors' money go to zero. So overall, if you ask on the portfolio view, I am more bullish. We are increasing our portfolio beta over last 1-2 months. We believe the pivot is coming and think good things should come. Hopefully 2023 will be a pivotal year, and 2024 onwards you start making very decent money.
All right, that's clearly the strategy that is coming for you. But how do you now approach the overall IT basket, if I may so ask? Because, there have been concerns around the Yellen comments, at least suggest that it's not going to be any blanket approach coming in for all the deposits, right? So that's an area of concern, at least when you speak about the mid-sized bank. So with respect to that, you think Indian IT sector, which has got more exposure, at least the mid-cap names that have got more exposure to the mid-sized banking system, could see some near-term pain, if not for a complete year of losses, if I may so say?
So there is a risk in the IT services pack. And important things, Nikki, is that guidances will come out. Most IT companies give their guidances in the second week of April. That means in the next 2-3 weeks. Now, these IT services CEOs cannot themselves know what is happening, right? And what will demand look 1 year forward. So it's going to be a risk off. Like we've cut weights in IT services last week in our portfolio. And let's see how it goes. It's a very dynamic situation. See, we strongly believe the only way to come out of a bubble is to create an even larger bubble. That's what US has done over the last 100 years. And till the time the printing doesn't happen, why bet on IT services? There are so many good companies which are growing at 25-30%. So for us, we've gone very highly underweight on IT services.
All right, so that's the word on the IT services overall. But how do you look at the banking system right now? There is this amount of correction which has come through for the PSU banks. I'm sure the last time also that we spoke about, we exactly kind of indicated and were circling our discussions around the valuations, the earning growth potential. How contingent, is the system right now? And do you think there is going to be a spell of risk coming in from the globe for the overall Indian banking sector, or you think we are well regulated, well insulated?
See, this time, Nikki, unlike 2008, this is not a credit risk problem. It's a duration risk problem that most banks took because of their held to maturity portfolio. So the Indian banking system, but people are generally, if you speak to FIs and fund managers, people are generally now saying that our banks, it's highly leveraged business. If 170-year-old bank goes bankrupt, like Credit Suisse, why be in this segment? Why have an overweight on this segment? It's a leveraged business and mistakes are unknown. So people are generally going overweight based on those historical facts. But overall, the Indian banking system is very strong. The top 3-4 private sector banks look very decent. The NBFCs have fallen a lot. The first NBFC to recover would be the consumer lending leader. And when that starts recovering, only then the smaller NBFCs will start recovering. Here, the main consumer finance leader himself is struggling. Basically, the leader of the NBFC space is struggling. So all the babies of NBFCs are also struggling. But overall, I would say banks look very reasonable. Yeah. If you think about it, the market goes up 10-20%. I believe these banks will go up 30-35%. So because in fund management business, you get paid for outperformance. I believe that if the Nifty goes up 15-20%, banks will go up 30%, 40%. They are very reasonably priced right now. The only problem is there is some kind of over ownership. Every mutual fund has loads of banks, but the whole trade is when FIs come back in the market, they will come and buy these banks. So that's the trade, Nikki, that everyone's praying and playing for.
All right, I'm not going to ask you what exactly are you adding to the portfolio when it comes to the banking names, but I'm definitely going to ask you, of the large cap and the mid cap, which is favorable right now, and where do you see earning potential upside?
So Nikki, actually we're buying high growth stocks. We are increasing our hyperscalers. So as I spoke to you last time also, in the next 10 days, we start the earnings season. And it's a very tough economy out there. Our GDP growth was 4.5%. 4.4% last quarter. So it's a tough economy in every sector. If there are 10 players, only 1 and 2 players are going to do well, or 3 players will do well. They'll show 20, 30, 40%. Wherever you see growth, that is where we're gonna ride, because we expect that very soon we'll see a very large change of market sentiments, and we want to be so. This is what we feel, that Fed and Fed acts like printing of money, acts like steroids, and growth acts like workout. So once you get steroids and workout together, you build a very nice muscled body. That is what, if you need growth, that is your workout, and you need steroids from the Fed. Once you get the combination of two, Nikki, for months and months, you'll see very large trends that will come, and growth in a 4.5% kind of GDP growth environment is going to be scarce, and market chases growth, and that is where the largest money would be made. So we've added some consumer tech last quarter. We don't add so many stocks typically, but we've added some fintech, 2 names we've added in the fintech basket. The same things. We've got technology, we've got pharma. We have 0 positions in pharma, but we're looking to add some pharma now, like more on the hospital side. Right. But very few changes.
So you're looking to add pharma more on the hospital side. You've actually cut down on IT, and you're bullish on banking. Apart from these 3 sectors, is there any sector right now that you think is attractive, that needs to be looked at? Momentum, of course, we're talking about hotel stocks. We've been speaking about potentially how, even city gas distributors, for that matter, could do well. What's your view on that one?
So utilities, we don't typically track or invest, so I'm not the best person, but consumer is 40% of my portfolio. So any given point of time, 40-45% of my portfolio is consumer companies. Companies which are growing at 20, 25, 30%. So in the consumer side, we've got grocery. So we might add. So right now, Nikki, valuations have become very reasonable in consumer companies also. I'm not speaking about the FMCG names because I want higher growth. But from a cola player to grocery retailer to jewelry retailer to a watch retailer, I think we've got across the buy. We've got an electronic retailer in Bihar. So across the board, and these are companies which are growing at 20-30%. So we are in consumer pharma we are 0 right now, but we want to add. But yeah, consumer is where I think we're adding the most. Like that is our highest overweight. That is where we are 40-45%. See, consumers don't fall in bad times. That is the most important part. Typically, they don't fall a lot in bad times. And in good times, they will lead the market. So our consumer financials portfolio, hopefully, will do very, very, very well in the next upcoming bull market. Even consumer tech, one should look at the fintech guys. They will also lead. In retailers also, we've got even a clothing retailer, which is growing at 50-60%. And you need to find growth in good companies, find growth. And you can make a decent 20-25 stock portfolio.
Amit, since it's an important day, an eventful day, I'm just going to ask you to provide more food for thought for our viewers out there. A, if you could help us with which are the sectors over and above what we've discussed look attractive, and B, any 2 stocks that look attractive at this point of time which the viewers can consider and take away from this conversation.
So if you get a dip, you can buy. This is not a recommendation, and we have vested interest. I'm just going to give one stock idea, which I think that people are not going to hit stones on me. So I'm going to give. I think on a dip, you can buy DMart. If you get a 10, it's trading at 50, 60 times. This is not a recommendation again. It is part of our portfolio. We will also add more weights. It's a 3-4% part of the portfolio, and we'll increase the weights if we get a dip. And what else? Yes. So that is the only stock. I think it's a very, I don't think I can go, hopefully we won't go wrong there. A very large market opportunity. Every quarter, you'll see a 25-30% kind of growth for next 5, 6, 7 years. And the profit this year should be around 2,400 crores. I see there a clear runway that this entire decade, the profits of DMart should be north of 10,000 crores. So this is what I feel, and I can be horribly wrong, but this is what I strongly believe, that is one stock that you can buy. See, the other stocks, what I say today, I don't think that I don't know if I will be holding it 5-7 years from today, but we do have exposure to fintech companies, the 2 fintech listed players. We do have exposure, and these are riskier bets. You need to have some kind of stop losses, but if we go right, I think we'll double, triple our money.
And how about the sectors? How about the sectors? Sure, you've spoken about fintech. Anything over and above fintech that looks attractive to you right now?
Yeah, we've got, actually this retail is where we are heavily invested. So if you go to the US market and see what created the largest wealth, you go to China and see what created the largest wealth. Once the GDP crossed $2,000, it was not the FMCG companies. It was retail. And in retail, if you just fundamentally think about it, in grocery retail, there's one player. In jewelry retail, there's one player. In electronic retailer, there's only one good player. In fashion retail, there is only one good player. In watch retail, luxury watch retail, also there's only one player. We are looking for only ones, not just number one, only great guy in that sector who are growing at 25-30%. They're adding 15-20% new stores, and the old stores are growing at 8-10%. In QSR also, we're looking at buying one player. That is, it's a very different player. We at a very old, few months back, like 8-9 months back, we used to own Jubilant Foods, and we owned the Jubilant Food for a very long time. But there's a new player that will be adding on the QSR side. Nikki, in retail, coming back to retail, I believe for this decade, retail is one where the industry is growing at 12% and better players are growing at 20-25%. I believe retail will lead not just this bull market, this entire decade. Retail should do very, very well because there are monopolies which are getting created in the retail space across categories, and the opportunity size is very, very, very large. What do you ideally want? You want a player who's 2%, 3% of the entire market, growing, but a market leader and growing 2 times, 3 times faster than the industry. And that is happening in every retail company. They're growing at 20-25% quarter over quarter. We've also added one footwear retailer now. It's a cheap 20p stock. We typically don't buy very low P, but the company is growing at 30-35%. So, and it's going through a demerger. In the next 4 days, it's going through a demerger. So, you're getting opportunities in the market. This year, the next 2-3 years are going to be fabulous years. So it's been 18 years of bear market. People are frustrated. Sentiments are poor. I'm telling you, people who come in now or are already there and play the next 2-3 years right, I believe a lot of money will get created. Like serious wealth will get created in the next 2 years. I'm very optimistic. I'm not bearish at all.
Amit, we're just running short of time. 30 seconds on this one. We're in bear, bull, or consolidation phase right now. What's the strategy that you think our viewers could adapt at this point of time? Do you think they should kind of wait and watch for dust to start settle in a little more, or think right now with the Fed rate hike coming through and the comments being a little bit of dovish, you think it's an opportunity to go out there and buy?
See, we are always invested. So we don't know, like we are in a consolidative phase. For sure, very few companies are doing well. But I do expect, so every 4 years there's a bull market. Last bull market was in 2021. The big bull market will happen in 2024, 2025. And 2023 is where you are. You've gone through 18 months of consolidation, 2, 3, 4 months here and there, but a big bull market is coming.
All right, Amit.
The Fed will pivot. There will be printing of money again because you cannot come out of a bubble. The only way to come out of a bubble is to create an even larger bubble. The Fed will have to print again. And Nikki, the kind of money that will get made will be too good.
All right, that's the prediction coming in from Amit. That's the bull market that he's expecting coming in for the next year, if not for this year. But we're going to leave it at that, Amit. And thank you so much for taking out your time this morning and speaking to us.
Thank you so much.
All right, with this, it's a wrap, and goodbye from the entire team who puts this piece together. Thank you so much for watching. Please do post your feedback for us in the comment section below. Follow us on the link at the bottom of your screen. For rest of the updates, stay tuned in to moneycontrol.com and Moneycontrol app.